Hi everyone, welcome back to Alex House Strategist. If you're thinking about buying a home or an investment property in Canada, there's a big change coming from Canada's banking regulator, OSFI, that you need to know about. Starting in 2026, the rules for mortgages on income-producing properties, like rentals, are getting stricter. Don't worry, I'm here to break it down in a way that's easy to understand, share a real-world example, and give you actionable steps to take now and after the rules kick in. Our goal, to help you make smart decisions as a buyer. Let's dive in. What's changing with OSFI's rules? OSFI, or the Office of the Superintendent of Financial Institutions, just finalized updates to how banks treat mortgages for income-producing residential real estate. These changes start in the first fiscal quarter of 2026, basically, early next year for all banks. The big focus is on how banks calculate your income when you're applying for a mortgage on a property that generates rental income, like a duplex, or a house you plan to rent out. Here's the key change: OSFI is cracking down on something called double counting income. This means you can't use the same income, like your job income or rental income from one property, to qualify for multiple mortgages. For example, if you're using your salary to qualify for a mortgage on your primary home, you can't use that same salary again to qualify for a rental property mortgage. OSFI wants banks to be stricter to ensure borrowers aren't overextending themselves. Why should you care? Well, if a property is classified as income producing, meaning more than 50% of the income used to qualify for the mortgage comes from rent, it comes with higher capital requirements for banks. That could mean higher interest rates or tougher qualification standards for you, the buyer. These changes are all about making sure the housing market stays stable, but they could affect your ability to buy that dream home or investment property. Let's make this clear with an example. Sarah, a buyer who wants to purchase a rental property. Sarah earns $80,000 a year from her job and is looking to buy a duplex to live in one unit and rent out the other. Before the rule, now, Sarah applies for a mortgage on a $500,000 duplex. The bank looks at her $80,000 salary and the expected rental income from the duplex, say $30,000 a year. The bank looks at her $80,000 salary and the expected rental income from the duplex, say $30,000 a year. The bank combines these to assess her ability to pay the mortgage. Because her job income is strong, the bank qualifies her easily, and the mortgage isn't classified as income producing, since less than 50% of the income comes from rent. Sarah gets a standard mortgage rate and terms. After the rule, 2026, now, let's say Sarah already has a mortgage on her primary home, using her $80,000 salary to qualify. She wants to buy that same $500,000 duplex as a second property. Under the new rules, the bank cannot use her $80,000 salary again for the duplex mortgage because it's already tied to her first mortgage. Instead, they'll only consider the $30,000 rental income from the duplex, plus any other income she might have. If that rental income isn't enough, the mortgage might be classified as income producing, which could mean a higher interest rate or even a rejection if she doesn't qualify. This change makes it harder for people like Sarah to qualify for multiple properties, especially if they rely on a mix of job and rental income. Banks might also set tougher internal standards, so it's a wake-up call for anyone planning to invest in real estate. Okay, so what can you do before these rules kick in early 2026? Here are some practical steps to take now, keeping your best interests as a buyer in mind. Apply for a mortgage ASAP if you're ready. If you're planning to buy a rental property or a second home and rely on both your job income and rental income, now is the time to act. The current rules are more flexible, so getting pre-approved or locking in a mortgage before 2026 could save you from stricter qualification standards. Talk to your bank or a mortgage broker to explore your options. Strengthen your finances, boost your savings, pay down debt, and improve your credit score. The stronger your financial profile, the better your chances of qualifying, even under the new rules. If you have multiple properties in mind, start organizing your income sources now to avoid relying on double-counted income. Work with a mortgage expert. A good mortgage broker can help you navigate the current rules and find lenders who might be more lenient before the changes take effect. They can also help you structure your application to maximize your approval odds. By acting now, you can take advantage of the more flexible rules and potentially secure better mortgage terms. Don't wait until the rules tighten up. I'm Alex, your mortgage strategist. Let's make your dream home a reality. A bank offers a product. I offer a solution. If you're ready to take the next step with your mortgage, click the link below.